Thank you, everyone. And thank you again for joining me for part four of the series on tax implications for selling a business. Again, my name is Mike Desiato. And today I'm going to take a little detour from pure tax. I'm going to focus more on deal structure. Specifically, I'm going to be talking about working capital targets or the working capital peg, and also this concept of cash-free, debt-free terms, because these are the two biggest drivers of what a seller actually walks away with at closing. So during this, I want you to all keep one thing in mind. The headline price, all right, the top line price is very important, but it's not the same as the net cash that the seller puts in their pocket. We're going to see things like working capital adjustments, debt payoff, transaction expenses, and escrows can all materially change what the final number is. And my goal today is to kind of show you the mechanics of how these things work so that you can help your clients understand them and improve on them. So before we dive in, I wanted just to give everyone a heads up. Our last webinar in this series will be held on July 9th. And in that session, I'm going to be pivoting back to taxes, and I'm going to cover another major driver in what the seller actually walks away with, and that is how taxes are going to be dealt and how to deal with them to minimize taxes and increase the amount of money that your client's going to put in their pockets. So stay tuned for that. I guess we're going to take off for the 4th of July holiday here. And let's move right on into working capital. Okay, let's talk about working capital and the working capital target, sometimes called the peg. Okay, and we're going to cover a couple of things around this. We're going to talk about how working capital is defined. We're going to talk about how it impacts the transaction. And then we're going to talk about what a seller can do, what your selling client can do to improve this result. And why is working capital an issue? Why is it coming up? Well, when a buyer buys a business, right, they expect it. They expect the business to come along with enough working capital to keep the business operating on a day-to-day basis. Working capital is what funds operations between the time cash goes out to your vendors or suppliers and the time it comes back in after you've billed and collected it. That's the operating cycle. So if you think of working capital, and I kind of do this, it helps me understand it a little bit better. If you think of working capital as gas in the tank when you buy a car, right? So when you buy a car, you expect it to have gas in the tank so it can run. Well, buyers feel the same way about a business. They don't want to write a big check for buying your company and then immediately have to put more money in to keep it running. So the agreed amount of gas in the tank that they require is the working capital peg or the working capital target. And in most transactions, this peg or this target is one of the most negotiated financial terms in the purchase agreement. It's going to affect the purchase price. It could affect the purchase price, as we'll see directly. And so even modest changes can move the seller proceeds by a meaningful amount. So let's talk about the definition of working capital. And we'll start with the GAAP, the generally accepted accounting principle concept of working capital. So in the accounting world, working capital is current assets minus current liabilities. So what is that? Well, current assets include cash, receivables, inventory, prepaid expenses, and other trade receivables. And subtracted from that is current liabilities, which include trade payables, accruals, taxes payable, pension obligations, and the current portion of any long-term debt. So that's the GAAP definition of working capital. Now, when computing working capital, there's a lot of variables that impact the calculation. One of the things that impacts it is what period are we going to use to calculate this? Also, excuse me, we also have to look at the number of the aging of the accounts receivable, the number of days in inventory, the number of days in payables, and other operating cycle metrics that can all materially change the working capital picture. And I can tell you this, a single balance sheet date can look very different from a trailing 12-month average of working capital. And usually buyers want to see a normal amount of working capital for the business. And that's not going to be the working capital in any specific date. They're going to want a normalized working capital number to deal with. So we'll get into what that looks like in a moment. So from a seller's perspective, working capital is something that really needs to be analyzed before you go to market. And it's not a term you want to wait until until you get your LOI. And the key factors that determine this working capital number are the seasonality of your business, the growth rate of your business, what are industry norms around working capital for your business, and then we look at ratios like what's working capital been to as a percentage of sales, what's working capital been as a percentage of EBITDA, and also if there's any extraordinary transactions in there. So I always tell sellers that it makes sense to clean all this working capital stuff up early. All right, because that'll improve your negotiating leverage and also your ultimate cash realization. And that means, from a practical standpoint, you need to understand your normal pattern, and you need to remove a lot of noise in these numbers and the working capital number before the buyer comes in and determines what they think the peg is. So from a buyer's point of view, the working capital to them is really an operating and financing issue. They want to know whether the business will have enough liquidity to continue operating and growing after closing without having to make a fresh equity injection. So they're going to be focusing on your receivable reserves, on inventory reserves, on the quality of your accruals, the cutoffs that are being used to calculate things, and also the growth-related working capital needs of the business. If any of these things look very weak, or if these things look overvalued in terms of receivables and inventory, or if the accruals are under accrued, then the buyer's going to usually argue for a higher working capital target, or they'll adjust the price. So it's very important here to have strong fundamentals to make it easier for you representing the seller to defend a much lower working capital peg. So I like to go to examples when we're talking about things. So here's a good little slide. It's a GAAP representation of working capital. And you can see at the year end here, we have, cash, receivables, inventory prepaids, other receivables, total current assets of $3.4 million. And then on the liability side, we have payables, we got accrued payables, we got pension payables, we got sales tax payable, we got current portion of long-term debt. That totals about $1 million. So from a GAAP perspective, at the end of the year, right, which is at 12/31, there's $2.330 million of working capital. Okay, now what you need to understand here is that looks different than what a 3-month average of working capital may look like, and it even looks even more different if you look at a trailing 12-month average of working capital. And this spread here that I'm showing you really matters to a buyer, because the buyer wants to get they really want a good indication of what the normal needs are. And that normal need is not something that is reflected on one day of the year. So they're going to look back at either a 3-month or a 12-month average. So you need to understand when you're going into a sales process, what period is the buyer going to be looking at in order to determine the peg? Because you can see here, the difference is almost $400,000 between one day of the year and a 12-month rolling average. Hey, Ed. So that's what this slide kind of shows. And so let's move now from accounting theory to deal reality. And usually what happens is the purchase agreement definition of working capital, usually the purchase agreement definition is going to usually depart from the GAAP definition. And that departure is where a lot of the economic negotiations go in. And so the key points here to keep in mind is, first of all, whether or not we're going to use a trailing 12-month analysis, right? What is a good period over which to measure the normal amount? Is it 3 months? Is it 12 months? Is it 18 months? That's something that has to be decided. The other issue is, does it exclude cash? Okay, does the working capital number exclude cash? And we'll get into that in a moment. Also, we need to talk about how customer deposits are going to be handled and how does this work with cash-free, debt-free? Because most transactions today are cash-free, debt-free. Also, we need to know how interest-bearing debt is going to be handled, and also whether or not any recast adjustments are going to be applied into the working capital peg. So these choices convert directly into dollars in or out of the seller's pocket. So let's go through another example here. So here we have working capital now per the agreement. So I'm starting off here with the GAAP number on this line, 2.330 million of working capital. That's the generally accepted accounting principle computation. But now, usually what happens in the agreement, that number or that amount gets modified. And so we see here, you see $300,000 of cash being taken out. You see $420,000 of receivables being taken out. And then you see $200,000 of long-term debt being added back and excluded liabilities of $10,000 being added back. So now the working capital per the purchase agreement, and this is after negotiations now, are $1.8 million versus the 2.3 that GAAP would tell you working capital is. Now, so why are these adjustments being made? Why is this happening? All right. And the other thing, too, to point out here is not only is it $1.8 million, but when you look back over, if you do a 3-month rolling average or a 3-month trailing 12 months, in this case, it's 1.7. And if you use a 12-month average, look back, trailing 12 months, or I'm sorry, 12-month average, my bad, it's $1.5 million, right? So there's a difference here between the year-end number, 3-month average, and the 12-month average. And oftentimes, what happens is there's a negotiated working capital target based on this analysis. And let's assume that the parties agree that's $1,750,000. That's the target number that the seller is going to have to deliver in terms of working capital to the buyer. Okay, so let's talk about why some of these adjustments are being made here. Well, the first one is cash. Cash is being taken out of the working capital number because in most private deals, the way they're priced on a cash-free basis, meaning that all the cash goes back to the seller. It's not part of the operating working capital delivered to the buyer. Okay, so that comes out. You don't have to deliver that. That stays with you. But there's an important caveat to that in a moment. Now, other receivables here are being taken out. That's $420,000. And oftentimes, these are receivables because oftentimes some of the receivables represent shareholder loans or intercompany balances or non-trade types receivables. It could be from employees. A buyer doesn't want them, and they're not going to expect to rely on them to run the business. So that's going to be excluded, and that's going to be backed out of the working capital number that you're going to have to deliver because they don't want them. Usually, in that case, these items that are being backed out, these receivables, are going to be kept by the seller and not transferred as part of the business sale. Then we see long-term debt being added back. All right, we're adding it back. Now, debt usually reduces working capital, right? Net working capital, but now we're adding it back. Why are we adding it back? Because in these deals, these private company deals, which are cash-free, debt-free, that debt is going to be paid off at closing. All right, so it won't be there. So it's not an operating working capital requirement. That will be removed. The seller is going to have to use the cash that it has to pay off this debt. Also, we have, in this case, some excluded liabilities. You could have some liabilities that are carved out they're not going to be used to depress the working capital peg. So oftentimes you have some obligations that aren't going to be assumed by the buyer. Okay, so conceptually, what happened here is this agreement strips out non-operating and seller retained items from current assets and it strips out financing and carved out items from current liabilities. And now you get a definition that's more aligned with cash-free, debt-free, and also the level of working capital the buyer actually needs and will receive. And so in this example, as I said, the negotiated target is 1.75 million, and it illustrates a very key point, right? So what sits on your balance sheet as of any particular point in time is not necessarily the working capital peg in the deal. Okay, there's a lot of adjustments that need to be negotiated, and you're often looking at, working capital averages over a period of time. So, what can you tell your sellers or your clients to do in order to increase cash at closing and do some advanced working capital management? So, the good news is that the seller can influence the outcome through better working capital management, ideally beginning 12 to 24 months before a sale. And I'm going to highlight four levers: customer deposits, customer payments and prepayments, vendor credit terms, inventory turns, and cycle times. These are four items, four levers that a seller can work with 12 to 24 months before a sale. And the goal here is to shrink the amount of cash that's tied up in receivables, inventory, first in receivables and inventory, and then sensibly use accounts payable and other efficiencies so that you require now less net working capital to support the same amount of revenue. So if you're able to bring your net working capital down and support the same amount of revenue, that's going to translate into a lower working capital target or peg and more cash to you at closing. So it makes sense to start your clients to start working on this, 12 to 24 months ahead of time. So when we let's talk about customer payments and prepayments, right? So if you tell your clients, look, you want to bring your receivable days outstanding down, meaning that, if you're getting paid, if you're asking for 45-day terms, you may want to bring it down to maybe 30-day terms, right? You also may want to require your clients to get deposits or do milestone billing for weaker credits. Offer targeted pay incentives where margins are not, where margins support them. The other thing I've seen used is retainers or annual prepayment options for recurring services. And also, you have to enforce credit discipline. So you have to professionalize collections. You got to have standard reminder cadence. You should use electronic invoicing. So you want to speed up the collection of your receivables so that you don't need as much in terms of receivables to support the amount of revenue that you have. The other thing too that I tell clients to do is clean up your bad or related party receivables. Get them off your books, because if you don't, they're going to be looked at by a buyer as, and not necessarily those in particular, but it's going to show a larger receivable number, which can then influence the buyer to say, well, I need a higher receivable amount because you've been carrying this amount all along. Well, again, in addition to collecting those things and getting them converted to cash, the other thing is trying to clean them up and get some of the bad stuff out of there. And so if you do all this good stuff, then as I said, you're going to be able to show that you need less accounts receivable to support the same amount of revenue. And that is going to then require the working capital target to fall. If we go to the credit side, if we go to the liability side, your vendor credit terms are something else that your client could start working with. And, I tell clients, look, start using those terms more strategically. If you can, renegotiate the terms. If they're net 30 now, maybe you can get them to go out to 45 days where feasible. And don't pay early. I have a lot of clients that love to pay early because they think it helps them. But if you do that, then you're going to keep that accounts payable balance low. And then what's going to happen by keeping that low, it increases the amount of net working capital you have on hand. So you want to make it, you want to stretch it out and stagger the payments as much as you can where feasible to make that to make that accounts payable balance higher. And so as a result, it reduces the net working capital peg. The other thing too, in this 12 to 24 month period, you want to avoid making large prepayments for services or goods, because these prepayments show up in working capital as prepaid expenses. So they increase current assets, and unless the economics are compelling, and you're confident, unless they're compelling, and you ought not to do it unless you're confident that that prepaid expense is going to be thrown out when you calculate the required amount of working capital. So try to avoid these large prepayments or prepaid expenses if you can in that 12 to 24 month period. And again, having higher normal payables reduces net working capital, and it's going to lower that working capital peg. Let's talk a little about inventory turns, right? You want to, like you do with receivables, you want to reduce the amount of cash invested in inventory without compromising service, right? So you may want to rationalize your SKUs. You want to run down or liquidate slow-moving and obsolete inventory, and you want to recalibrate your safety stock based on actual lead times and demand. So, tighten your purchasing window, improve data and controls to avoid having ghost inventory. And, the goal here is to have lower high quality inventory and lower high quality inventory balances that will drive down the normal inventory level that's going to be used in the peg. And then finally, we can talk about cycle times. And cycle times is basically your cash conversion cycle. So that is the time period between the time you pay your suppliers to the time you collect money from your customers, right? That's the whole conversion cycle. So here again, we talked a little bit about this with receivables and payables. You want to make sure you invoice very promptly after you deliver or at milestone point. You want to automate automate billing as often as you can to cut delays between the work being done and the time it's billed. And then you also want to align your accounts receivable and accounts payable, because you don't want to be in a position where you pay your suppliers in 15 days and you collect your money in 60 days. Okay. So that's going to be a problem, because you're going to have very small payable balance and a large receivable balance. So where appropriate, again, try to negotiate better accounts payable terms, better inventory lines, better supplier financing lines, because that will basically increase the payable side of your working capital number, and it will cause the peg to follow, the working capital target to follow. So those are some of the things that your clients should be doing. They should be doing it anyway, just for good business practices. But especially within 12 to 24 months of a transaction, you want them to start honing in on, tightening up their cycle times, their cash conversion cycle, collecting their receivables, not getting rid of excess inventory, not overstocking inventory, having just the proper amount of inventory, and using their trade financing to the maximum without causing any issues. Because all that together is going to reduce this working capital peg that the seller is going to have to deliver to the buyer. Okay, let's move on to cash-free, debt-free. I used that term already. What does that mean? Okay, that's another important concept here. So this cash-free, debt-free is really very closely linked to working capital, and it also links exactly or actually to what the seller gets at closing. And I'm going to cover the definition of what it is, what debt is excluded, what kind of debt is assumed, and how all this impacts cash at closing. And this is where enterprise value begins to convert into equity value, and then from equity value into actual proceeds. Okay, so this is where the headline number becomes the actual settlement number, the settlement statement number. Okay, so let's talk a little bit about this. So what is cash-free, debt-free? Well, cash-free, debt-free, let's think about this. So the value that your business, the value assigned to your business is implied by the EBITDA multiple, as implied by the EBITDA multiple used to value it, really represents enterprise value. Okay, enterprise value is the total value of your business. Okay, and if you think about it, kind of like a balance sheet, if you will, because that's how I look at it. Enterprise value is the asset side of the balance sheet. This is the total value of your business. However, on the right-hand side of the balance sheet, you have two claims or two interests in that enterprise value. You have the amount that's been one of the interests that has a claim on that value are the creditors or your creditors. They have contributed and they have a claim on that total enterprise value. And then there's the owner, which is the equity value, right? So what we do here on this cash-free, debt-free basis calculation, we take the cash out, we pay off the debt, and we leave a certain amount of gas in the tank for the buyer, right, to operate the business. And then what's left after that's been done is the equity value of the company, all right? So the buyer then is conceptually acquiring the operating assets and the cash flows as if the company will be delivered without excess cash and without any financial debt. And as I said, the long-term debt is typically paid off from the purchase price, and the remaining cash generally goes to the seller. So the business, again, is delivered without any debt, and the balance sheet is normalized. We'll get to an example of that in a moment, but that's kind of what cash-free, debt-free means. Now, this slide kind of addresses some of the issues that come up in debt. Sometimes, debt is obviously long-term loans, overdrafts, related party debt. But there's also debt-like items that need to be discussed and whether or not they're going to be paid off. Do they have to be paid off in this whole transaction? So you have things like tax liabilities, deferred revenues, customer deposits, overdue creditors, pay time off. Okay, so point here is that debt is broader than bank debt. It often includes obligations the buyer doesn't want to inherit without a price adjustment. So you have to properly identify these things and negotiate them ahead of time in order to protect the seller proceeds. So whether or not these are debts that need to be paid off or debts assumed, that's something that has to be negotiated. And you also have debt that's assumed, right? You have trade payables that are tied to acquired assets, such as raw material payables. They're often assumed by the buyer. And there also can be other liabilities that may be assumed. But again, it's negotiable. You got to negotiate that stuff based on the facts. And of course, this slide, again, highlights the fact that, cash-free, debt-free, and working capital are interrelated. So as we'll see in a moment, we'll go through an example. If the actual working capital at closing is above or below the target, that variance then is going to flow directly to the seller proceeds through a purchase price adjustment. Okay, so that's how it matters. So let's go back and look at an example. Go back to our original example here. And here is, this is the cash-free, debt-free example here. So we already went through this, where we went from our GAAP working capital to our purchase price calculation, and we agreed that the PEG was $1.75 million. And that's going to become the benchmark at closing, and also in any post-closing true-up. So it's very important that sellers take a look at this and understand this. But let's go back and see what happens here. So let's apply this to a situation. So let's assume that the PEG is $1.75 million, but now we're closing. We close, and what happens when you close is there's an estimate made of what the net working capital is on the closing date. And in this case, it's $1.954 million. And the target is $1.75 million. So the excess that we're delivering, that the seller is delivering to the buyer, is $204,000. So if that happens, that's the case, then what happens is the purchase price is going to be adjusted, right? So this surplus of $204,000 is going to increase the sales price, in our case of $10 million. It's going to be bumped up by $204,000. So now the seller, the actual closing available cash is not $10 million, it's $10,204,000. Okay, so if that closing capital, the actual working capital, is above the target, that excess goes to the seller. If it's below the target, it's going to be taken away from the seller. Okay, so that's why this target amount is very important. How you set it, what's in it, and how you measure things is very critical because it's going to have a direct impact on the amount of cash that the seller gets. And now we're going to go even further than that. So in addition to that excess working capital that we're going to get, which is great, now we have we go through a process using the use of funds analysis where we see now the difference between the gross price and the net proceeds. So in this example, since it's cash-free, debt-free, okay, the seller's gonna have to pay off the debt that's on the balance sheet, right? The revolving line of credit and the notes payable, which is $2.1 million. That has to be paid. Also, it has to be paid by the seller is all the transaction expenses, the seller's transaction expenses, which is $627,000 in this example. And then we have various escrow deposits, right? We have escrow funds or a deposit for indemnities and adjustments. And also, in this case, there was the OPP loans, the payroll protection plan loans. There was an escrow for that just in case the amount wasn't forgiven. And then the company had to pay for it later on. But the buyer said, I don't know if it's going to be forgiven, so I'm going to hold back some of the money. Okay. So you can see here that even if you have a strong headline price, you can see that there's a lot of holdbacks and a lot of deductions that can materially reduce cash at closing. So let's take a look at that. So let's go back. So we have our $10 million. We have a surplus of $204,000 because we delivered more working capital than what the peg was. And then we have to, as a seller, we're going to have to pay off that closing indebtedness, which is $2.1 million. We're going to have to pay for our transaction expenses. We're going to have to put $1 million, or actually $1,285,000 into these two escrow accounts, which could later on come back to us. But at closing, it's being separated and put aside. So now what's happening is, look at the cash at closing. Cash to close that comes to the buyer is $6.192 million. So the message here is clear, and it needs to be communicated that the enterprise price, the enterprise value, the $10 million, is not the same as cash at closing. And closing cash is not the same as after-tax cash. And we haven't talked about taxes, but that's our next webinar. Okay, so the way you negotiate some of these items, especially the working capital peg and what is indebtedness, what is going to be paid off, what is going to be assumed, does have an impact on the net cash at closing. But it's also very, very instructive for a seller to see or an estimate of how this is going to look like when they go through the transaction. Okay, let's shift a little bit now. Even though, let's say the transaction is closed, we're not done yet. Okay, we're not done, because now we're going to move into post-closing adjustments and true-ups. And this can happen even after the deal closes, right? We're going to cover what this means, common types of adjustments, indemnities, and how they can affect the cash the seller receives at closing. So even after closing, economics can still move. And sellers need to pay close attention to not only the initial purchase price, but also the mechanisms that survive the closing. So let's go back to an example here. So what is this post-closing adjusted true-up concept? What is it all about? Well, typically when you close, the seller is being paid based on estimated financial statement numbers. Those are estimates at the time of closing. Now, once the books have been finalized after closing, then the price, pursuant to the agreement, can be adjusted up or down based on the actual numbers, not the estimated numbers used at closing. So this is kind of the essence of this true-up post-closing adjustment thing, right? The buyer and seller settle the final purchase price once the final and better information is on hand. So common things and common post-closing adjustments. first of all, they're oftentimes they represent delays. They represent delays caused by you're waiting for regulatory approval, you're waiting for third-party consents, you're waiting for this maybe some due diligence that hasn't finished yet, but you closed, but there's still ongoing due diligence. There's still some tax matters that are being looked into. There's maybe litigation. There's maybe some other changes in financial condition. Um, there also is beyond that, beyond delays. There's also a working capital true up, right? Because you close based on an estimated number, not a final number. And then also you could have inventory issues and things of that nature. So what happens here is, you know, when the final numbers come in, then the final adjustments are made, and there could be things that still haven't been resolved yet that are waiting to be resolved, but those items will also be adjusted when we go through this process of truing up. Now, in addition to these post-closing adjustments and true-ups, we also have indemnities. We also have escrows, indemnity escrows, where portions of the purchase price are held back to satisfy potential claims against the seller. Okay, usually these claims and these issues are usually identified by the buyer when they do due diligence. They may find things like you may have some compliance issues with the law. You may have some issues with your contracts. You may have some maybe suspected litigation, maybe some regulatory investigations. There could be a whole host of things that the buyer discovered. They're unsure of what the effect will be, but they think there's going to be an effect. So as a result, they hold back some of the purchase price and put them in these escrows. And often these escrow amounts are negotiated, and they're also a percentage of the purchase price, or sometimes a fixed amount. And they can range anywhere from 5 to more than 15% of the purchase price. And oftentimes these holdbacks, so these escrows, generally last anywhere from 6 to 24 months. Okay, so they hold back the money, they wait to see what happens, and then once things clear, sorry, they'll go ahead and release the escrow, the unused escrow, to the seller. And again, escrow negotiation is also a very important in this price negotiation process, right? How much they put in here is very, very important. So let's go through an example again. Let's talk about some post-closing adjustment true-ups here. So remember when we did our closing in our example, the estimated net working capital was $1,954,000, and the target was $1,750,000. So that excess surplus working capital that we were going to get, and we did get, we got an extra $204,000 in that example because we were over the closing target, or in this case, it was the estimated closing target. Now let's assume that after the books have been closed, we find out that, oh, wait a minute, working capital was not $1,954,000. Okay, it wasn't that. That's what we estimated to be. In fact, it was only $1,844,000. Okay, so in essence, we need to adjust the price now $110,000. We need to bring it back. We need to take back $110,000 of that $204,000 that we gave away, that we gave at closing, because now we got the final numbers in, and now we're going to go ahead and get that, and then we're going to get this money back. So even though the seller benefited from the estimated closing, that benefit's going to be reversed when the final numbers come in. So how does that work? Where does that come from? So what happens is that escrow amount that was put aside, that $1 million, immediately coming out of the escrow, they're going to take, the buyer's going to take $110,000 out of it and keep that for himself. Okay, so now the escrow balance is now down to $890,000. So this is important, and this is why sellers have to think beyond day one proceeds, right? Some of the money that you may expect to come back to you still is going to remain contingent on final adjustments, true-ups, indemnity claims, and even satisfaction of escrow conditions. So that's how the escrow amounts can be used. It could be used for this true-up of working capital, or it can be used to cover any of the other, reps and warranties, breaches of reps and warranties, any other unknown issues that could impact the value of the company. the buyer's going to use this escrow money to remedy those situations. So let's talk about key takeaways here. Okay, let's talk about what we learned. So this slide kind of summarizes it, right? So as I said, terms and structure can materially impact the amount of cash to the seller. Sellers ought to be very, very in tune with and start working on 12 to 24 months ahead of a transaction. Start working on a thinner, well-managed working capital well in advance. In other words, start working on that working capital number. Try to bring it down. Try to use, collect your receivables. Try to minimize the amount of inventory. Try to maximize the use of credit lines and accounts payable terms to minimize the amount of working capital that will then result in a lower working capital peg that you're going to have to deliver when you sell. The second thing, too, to be wary of as well is don't sit, as it says here, don't sit on excess cash. Avoid the unnecessary accumulation of cash, because if a buyer sees that consistently on your financial statements, they're going to come to the conclusion, and erroneously so, that, hey, I'm going to need that amount of money. If you needed it, I'm going to need it. Okay, so you don't want to give the buyer any impression that you need all that cash. Okay, so don't accumulate excess cash. Also, the thing here, the other walk away and take away here is you got to plan for the full transaction runway. Okay, you got to understand what's going to happen throughout the whole process, not just on the closing day. Also, the other thing to think about as well here is to try to time your sale to the business cycle, right? You want to try to align macro expansion with the company's own revenue and EBITDA up cycles so that buyers can extrapolate from your recent strength, right? You want to try to sell when it's high, right? Sell high, buy low. You want to try to time the market to align with the upticks in your business. The other takeaway here too is to prepare thoroughly for diligence, right? Prepare thoroughly, because you don't want a buyer to come in and see all these risks and all these potential liabilities and then automatically start arguing for escrows, for indemnity reserves and escrows that they're going to hold back money from you, and then they're going to sit on it for 24 months and they'll wait for things to happen. And then you'll get it back. All right. If you prepare thoroughly for due diligence, you could probably eliminate a lot of the things that are going to cause a buyer to think that they need these escrow funds in order to mitigate against possible claims. And then finally here too, not finally, but what the other thing is also start addressing long-term income and estate tax planning way in advance. And again, that's going to be the topic of our next webinar on July 9th. And then finally, assemble a strong team. You need to have a strong and experienced team to coordinate tax, legal, and financial strategy long before an LOI is signed. So I think we're coming up on the end of what I have to say. And so I will wrap it up now and give you back some of your day. I think it's around 2:45, so we've done 45 minutes. But again, thank you for spending some time with me today. I hope that this session kind of clarifies for you why working capital is important in a sale of a business, why cash-free, debt-free terms are important, why post-closing true-ups and reconciliations are so important to understanding the real economics of a business sale. And I see the biggest mistake that I see sellers make is focusing, again, only on the headline price, okay? People focus entirely on that headline price. The better approach here is really to focus on net cash to the seller. After structure, after adjustments, after fees, after escrows, and then after taxes, which we'll talk about next meeting, Those are the things you need to factor into and focus more on what the seller gets to keep, not what the headline price is. So with that said, I'll close it up here.